So last week we tried to look at some basic things, and this morning we continue with the theoretical part of the group account again. So last week we spoke about the kind of shares that you have to buy for you to be able to have control. We are saying that it's only ordinary shares that give ownership. So if you are buying the ordinary shares, you are going to be having, or you are going to be having part of what? The ownership of the company. Preference shares of any form does not give ownership. Okay, and we also try to talk about the kind of what business combination we are going to be looking at. So we are saying that merger, takeover, inheritance, and all sorts of business, all sorts of ways of you consolidating or putting business together without paying for it. We are not going to be looking at it under the what? Under the consolidation that we are going to be doing, or the question that will be asked in the exam. It's only the acquisition. You have to buy the shares and pay for it, because we have to be able to identify the acquirer, who is the parent or who might be the investor. Then we try to what? Consolidate or account for this in any form possible. So we are saying that since you are going to be buying, what are the forms or what are the means that you can use to pay for the shares? And we try to look at you can use cash to pay. We can also use the share exchange. So we try to look at those things the last time, which we call the purchase consideration. So we will continue with the other means that you can use to again. But I wanted to say something about the purchase consideration. Okay. I wanted to say something about the share exchange. So we are still on the forms of purchase consideration. Okay. So we are going to be looking at the share exchange. We have looked at the share exchange, but we are going to be talking about other issues of the share exchange. Okay. So we are saying that the parent is going to issue new shares to the existing shares of what? Of the subsidiary. So we are buying 20,000 shares. So we just issue the share, maybe 2 for 3 or 2 for 5 or anything. We look at that the last time. But my problem now is that if you are issuing the shares, it can happen that you will incur issuing costs. Okay, if you are issuing the shares, it will happen that you incur issuing costs. So the parent can incur issuing costs. How would the issuing cost be treated? That is my concern. My concern is now about the 2 for 5, because we have looked at this. We have looked at this last week. But my problem now is you are issuing the shares to those people, but as you are issuing the shares, you have to incur issuing costs. You have to incur issuing costs, or maybe the existing shareholders of the company that you are buying, they are saying that they need the prospectus of the company to know whether they should be taking the shares, and you are going to be printing the prospectus for them. That can also be an issuing cost. It's a cost that you have to incur to issue the cost to them. Okay. How do you treat the issuing cost? How do you treat the issuing cost? Yes. Do you have anyone here who has an idea about how the issuing cost will be treated? Issuing cost. How would the issuing cost be treated? The share exchange.
Hello, sir.
Yes, I can hear you.
I think it should form part of the cost to get the total cost of the transaction. issuing cost will form part of the share issue.
Are we adding, if it should be form part, are we adding or we are subtracting?
We are adding.
Are you sure? Okay. If you don't want to, if you don't want to make the issuing cost to form part of the shares, what would have happened to the issuing cost? The issuing cost will be treated as an expense, isn't it?
Yes, sir.
Okay. But the shares, if you're having the shares will be, you are going to be crediting your equity shares, isn't it?
Yes, sir.
And the issuing cost will be debited as an expense, isn't it?
Yes, it will have effect. Yes, it will reduce it.
Okay. So since you don't want to expense the issuing cost now, it means that go and debit the issuing cost in the what? In the equity shares account. So the issuing cost will be treated as a transaction cost in line with IFRS what? 9 financial instruments. So any other cost that will be associated with the acquisition should be expense. So they can give you due diligence costs, they can give you professional costs, any other costs apart from the transaction cost that the company is going to incur in issuing its own security. All other costs should be expense, but the issuing cost will be treated as transaction costs in accordance with IFRS 9. What do we mean by the issuing cost being treated as what? Transaction costs under IFRS 9. If you are issuing shares to people to come and buy, would these particular shares be treated as asset in your books or liability? If you are issuing shares for people to come and buy, would this particular cost or would the amount that you are receiving, is it going to be treated like asset or a liability? If you are issuing shares, it will be treated as a liability, isn't it? Okay. So since it will be a liability, the transaction cost or the issuing cost will be treated like how we treat issuing cost for liability. Less can be. Okay. If you're issuing the shares, what you have is that you are going to be debiting your investment, the cost of investment. Okay, let's say it's 20 million. Okay. Then you credit your equity shares. You credit your equity shares because the shares will be increasing. Okay. So at the issuing cost, you debit the issuing cost itself, assuming you are not doing anything. Let's say it's 2 million. Then you credit what? Cash or bank. This is how you are going about it. So 2 million. But this one, we want to capitalize the issuing cost. We are incurring the issuing cost as a result of us issuing what? The equity shares. So instead of us debiting the issuing cost as an item on its own, the debit entry will be done in the what? In the equity shares account. So you will now come here, instead of you having the issuing cost over here, you will now do the debit equity shares. And if you know that if you are debiting equity shares, you are what? Reducing the shares. So they can give you a question and they say the company has incurred an issuing cost of what? Of 2 million in issuing the shares because they want to what? The time that they are issuing the shares, they incurred an issuing cost. The cost should be taken out from what? The amount, the equity capital. The cost should be taken out from the equity capital. So what you have is that the investment, you are issuing shares for 20 million. So what will happen is that if you go to the stated capital of the parents, go and subtract the 2 million. That is it. Any other cost apart from the issuing cost should be treated as an expense. That's what the standard says. The only cost that can be capitalized is the cost that the entity will incur in issuing its own what? Securities. And that will be treated in the line with what? IFRS 9. So they can give you professional costs, due diligence costs, acquisition costs, any other cost should be expensed to profit or loss if you are coming to consolidate. Okay. But we look at issues with if you are having investment in associates, the treatment of all those professional costs will be different from if you are dealing with the consolidation. So if you are going to be consolidating and the company is a subsidiary, it's only issuing costs that will be what? That will be capitalized. Other forms of cost will be what? Will be expensed as incurred. So take note of that. And let's look at the other forms of consideration. Okay. Yes. So give us the other forms of consideration and let's move on. Other forms of consideration. Okay. Other forms of consideration. Apart from the cash consideration, share exchange, what are the other means that we can use to acquire the equity shares or the investor can use to acquire the equity shares of the investee? Okay, deferred consideration. Deferred consideration. Okay. What is a deferred consideration and how does it work? How is that a deferred consideration? How does it work? Yeah, sinners. Deferred, yeah, Roxanne, deferred consideration. How does it work?
Okay, so please, with the deferred consideration, the parents, instead of paying the consideration to the subsidiaries shareholders currently, won't do that, but rather go into agreement to pay it in, let's say, a year's or 3 years or 2 years time.
Okay.
So with that, as the money is in the future and the topic is fair value of consideration paid. So if fair value of consideration, then you have to discount the future value to present value so that we'll be able to know the actual amount to record in our purchase consideration.
Okay. 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 So that is cool. That is cool. That is a purchase consideration. So with the deferred consideration, what will happen is that, yeah, Senior BC, I saw your hand up. Also,
Yeah, so to add up to what Roxanne said, the deferred consideration, after you finding the present value of the deferred consideration, you unwound to get your finance cost,
okay.
which you send to your statement of consolidated POL. If you are doing only the statement of financial position to you debit your group retained earnings.
Okay. Okay.
Thank you.
Okay. I have facts here. That is good. That is good. All right. So if you come to the deferred consideration, what we have the cash here, or we have the cash, or we might not have the cash. So what will happen is that, okay, no problem. We are going to buy the shares. But what will happen is that we are going to pay you in 2 years' time. Okay. We are going to pay you in 2 years' time. Or we are going to pay you, or we are going to pay you in 3 years' time. Okay. What we have to know is that the amount that if we should have the cash and pay these people today, the amount that we are going to pay them today will not be the same as what the amount that we are going to be paying them 2 years' time. So the deferred consideration will always come with an interest element because you are going to be holding someone's money for 3 years. If you should have given the money to the person can use that money to do something else and the person will be getting return on it. So the deferred consideration will always come with what interest elements. It will come with the principal, which is the actual amount that we are paying for the shares. plus the interest component. So what we have to do is that what is the principal payment? What should have been the amount? If we have cash today, how much are we paying for the shares itself? And what is the interest element? So the deferred consideration will always come with what? With an interest element that we call a finance cost. Because if you should have money and pay for the shares today, you will not be paying the same amount that you'll be paying in 3 years' time. But why are you paying more than the amount you should have paid today? Is because of the time value of money. So what you have to do is that just find the actual amount that you are paying for the shares. How do we find that? We try to separate the interest from the principal. So the question will give you the deferred consideration, or they will say something about that will indicate what a deferred consideration, and they will give you the cost of capital of the parent. So the deferred consideration, you just have to find the actual amount that you are paying for the shares. If you are paying 300 million in 3 years' time, you are not buying the shares for 300 million. No. You are paying 300 million because you are not paying on the day that you purchase the shares. You are paying in 3 years' time. So the people are factored in time value of money, and you are now going to pay interest on that amount. That is why you are paying 300 million. So what is the actual amount are we paying for the shares? How do you find that? You present value this, and they will always give you the discount factor or the cost of capital of the parent. So to know your purchase consideration, which is the amount that you are paying for the shares, the amount that you are paying for the shares. Okay, to know your amount that you are paying for the shares, you have to present value this. And this will, the deferred consideration will just be a one-time payment in the in 3 years' time. So that will be a lump sum. So we use a discount formula to present values. That will give you the 1 over 1 plus r exponent n. So to find the purchase consideration, we just have the amount that we are going to be paying, which is a future value multiplied by okay, so let me write this one well. Future value multiplied by the 1 over 1 plus r exponent n. Someone can also say his purchase consideration is calculated as the future value over 1 plus r exponent n. Okay, so assuming you are getting the purchase consideration of 180 million. Okay, how would the 180 million be treated? How would the 180 million be treated? The 180, are you paying to the people? Are you paying to them now? Are you paying the 180 to them now? Are you going to pay the 180 to them? Are you going to pay the 180 to them now? Yes, the answer is a big no.
No.
So if you are not paying, what you do is that it means that you have an obligation to settle a certain amount at the end of 3 years. So the deferred consideration, depending on the duration, will either be shown as a current asset or non-current will either be shown as a current liability or a non-current liability. So after finding the today's value of the shares, this is now your purchase consideration. Okay. So this is now so you debit the investment. So this is the investment that we are having in the subsidiary. So if you are buying shares in the subsidiary, that is an investment. That will be an asset for you. So debit investment, which is 180 million. Then you credit deferred consideration, because it's going to be 3 years, that will be a non-current liability, because it's going to be 3 years. So that is today. That is the initial recognition. But what you have to know is that you are going to be paying interest on the amount, because you are not paying today. You have to be paying interest, and the interest will be compounded. It's a compounding what? Interest. So whatever you are going to be doing over here, don't think that it's a simple interest. No, it will be a compounding. So you will be compounding to get the 300 in the future. So at the end of every year, the parent has to look for the interest. Okay, the parent has to look for the interest, which we call the finance cost. And that will give you the cost of capital, maybe 0.1 multiplied by 180. Okay, you'll be getting 18. So you will now increase your amount. This will go to profit or loss. If you are doing consolidated statement of profit or loss, this is an expense. So if you are doing consolidated statement of profit or loss, this will be charged as an expense. You add it to your finance cost. But if you're not doing consolidated statement of profit or loss, you are doing financial position, this will be treated, or this will be taken for the group retained earnings, which is the retained earnings of the parents. Okay, let's assume that you are doing it for 2 years. Okay, you are consolidating for 2 years. The interest for the second year will be calculated like this. It will now be, we have 0.1 multiplied by 198, because I told you that this is a compound interest. So compound interest, what will happen is that the principal together with the interest will be earning interest. So you add the first interest to this particular one to get your interest for this year. So you do it on the what? On the balance at the beginning of every year, and that is what we call the compound interest. You add the interest to the what? To the principal, then you calculate this. This interest will be sent to what? Profits or loss or group retained earnings, depending on the statement that they are asking you to prepare. Okay, so the deferred consideration, depending on the duration, will be presented as either a current liability or a non-current liability. If it is going to be taking more than a year, then it should be a non-current liability. But if it is going to be paid within a year or at the end of a year, then that will be shown as a current liability. Whatever is the case, it is going to be presented as a liability, because you have an obligation to settle for a particular period. You have an obligation to pay a certain amount to the existing shareholders of the investee or the subsidiary. So that is a liability. Let's go to the next one. The next form of what? Purchase consideration will be what? You know Olin. Mostly we know Olin 4, but I'll be telling you some other ones or some other forms that you can use, and that might also come in the exam and how you go about it. All right. The other one is what? Another form is what?
Contingent liability.
Contingent consideration. Okay. Contingent consideration, not liability. Okay, we have contingent consideration. How does it work? Contingent consideration, how does it work? Contingent consideration. Contingent is of contingent under provisions. Contingent liability. But how does it work? Contingent. The thing is contingent. Okay. So if you say, yeah, Roxanne.
Okay, so I think the contingent has something similar with the deferred. In that way, the contingent, the money is not going to be paid today. But then if it will be paid in the future too, it's not an agreement that it will be paid in the future, but rather the agreement will consist that it should be based on something. So that means, example, there will be like when you're able to achieve a profit of, let's say, 30,000 in the next 2 years, they will pay the rest, the remaining of the money or something like that. So with that one, so I think the money, instead of repaying it today, is in the future. So then we have to discount it as we treated the deferred liability since it's in the future.
Okay, thank you. Thank you. Any addition? Any addition to that? Okay. So if you come to the contingent consideration, it's just like the deferred consideration. But the deferred consideration, it is not based on any condition. Okay, we are going to pay you 3 years time, whether the company is doing bad or the company is doing good. We are going to pay you 3 years time. But for the contingent, the amount that we are going to be paying you will be based on what? A performance, or will be based on the condition. So we can tell you that if you're able to sack maybe 100 employees or 10 employees within 3 years, we are going to pay you these amounts. But mostly it will be based on a profit target. Okay. So maybe the company, the subsidiary or the investee might be making what? Losses. So they will tell you that if you are able to increase your profit by 20% every year, we are going to be paying you this amount at the end of the second year. Okay, so it means that the contingent consideration is also going to be is going to be paid in the future. So what will happen is that at the date of the agreement, you have to ask yourself, what is the what? What is the fair value of the consideration today? If we should pay this amount today, what should have been the fair value of the consideration? But if the fair value is not given to you, and they have given you the money that you are going to be paying, and they have given you a cost of capital, then you have to do the present value. But in exam situation, they will always what? Give you the what? The fair value of the contingent consideration at the date of acquisition. Okay, so it means that we are thinking that, okay, you are going to be able to achieve the 25%. So our estimate is based on 25%. It might happen that at the end of the year, you have increased the profit by only what? 15%. It means that we have to revise our what? Our estimates. Okay, so the question will always give you the fair value of the contingent consideration at the date of acquisition. Okay, the fair value of the contingent consideration, that will be C and C. The question will always give you that. But if you are not given, then they will now give you the amount that they are expecting to pay in 4 years time or 5 years time. Then you now do the what? The present value. You now discount it like a deferred consideration. Okay. At the end of the year, you have to what? Revise. You have to revalue your what? Your contingent consideration, because it is based on a performance condition. At the end of the day, the performance condition might not be the same as what you use to estimate it. Okay, so initially, if you are given the fair value of the fair consideration, that will be your consideration. So you debit the investment of the cost of investments. Then since you are going to be paying, it depends on the duration. If it is going for 2 years or 3 years, then that will be a current liability or a non-current liability. It's also an obligation. So you credit the contingent consideration either being shown as a current liability or non-current liability. So this is at the date of acquisition. So this will now be part of your consideration. Okay. But at the end of the year, you ask yourself, the estimate was on 25% increase in profits. At the end of the year, was a 25% increase achieved? If no, they were able to achieve only what? 15%. It means that we have to revise our estimate now to what? To reflect what? The actual performance of 15%. So at the end of the year, they will still give you the fair value of what? The contingent consideration. Okay. If they are giving you the fair value of the contingent consideration at the end of the year, it might be an increase at the end of the financial year. At the end of the financial year. So let's assume that at acquisition, the contingent consideration was 100 million. Okay, at reporting, it has now been revised to 120 million. What is happening there?
There has been an increase.
Okay, so there have been an increase. It means that this particular increase, how do we treat the increase? We know that we are going to be crediting the contingent consideration because it's a liability. We are going to increase it. But what will be the corresponding entry for that increase? If there is an increase in provision, what do we do?
P&L also coming.
Okay. So what you do is that whatever the estimate is, whether increase or decrease, it will be between profit or loss and what? The consideration. So it might be there is a loss in the what? In the fair value of the contingent consideration, or there is a gain in the fair value. So at the end of the year, you fair value. So there can be increase or there can be decrease. If there is an increase, it means that that is a fair value loss. That will be taken to the consolidated profit or loss for the parent. It will be treated in the books of the parent because it's the parent that is what? That is going to be paying these amounts. But if you are not doing profit or loss, then you have to take it to the parent retained earnings. You have to take it from the parent retained earnings, and that will be the group retained earnings. If it is a decrease, that will be a gain to the parent, and to be treated as a fair value gain. That is about the contingent consideration. Okay. Let's come to
Please,
yeah.
can you go by it again?
Go by which one?
The one you just finished. When there's an increase or loss on the consideration.
It will either be treated as a gain or a loss, and the parent is the one that is going to be paying the consideration. So if there is an increase or loss, it means that the parent is either having a gain or the parent is either having a fair value loss. So it will be treated in the books of the parents.
Mm-hmm. All right.
Okay. Let's come to the other forms that we are not familiar with. Okay. The other forms can be, you can also issue a loan note. You can also issue a loan note, or you can also issue debt instruments. Okay, so let me just say you issue debt instruments. It can be preference shares, it can be any other things. So you can, instead of you giving them equity shares, you can issue preference shares to them. Okay, and so you can issue, it can be through issue of debt instruments. So let me just say debt instruments so that the preference shares will be part of it. So preference shares, it depends. If it is irredeemable, it will be seen as a debt instrument, but the dividend will be treated as a dividend in case of equity shares. So we can also issue a loan note to them. We can issue a loan note to them. We can also issue preference shares to them. Okay, or we can also issue debentures to them. Okay, we can also give them debentures. The existing shareholders of the company, we can give them what? Debentures. Okay, so if you are giving a loan note to them, it means that we don't have cash now, but we are going to give you a loan note so that you be part of the creditors or you be part of the loan note holders of the company. Okay, so what will happen is that the question give you how the loan note will be issued. They can say they are going to be issuing 100 Ghana cedis for every 20 shares that has been acquired. So you have to calculate it. Okay, so they can say the loan note value is 80 million. This is the amount that you are paying for the shares that you are acquiring. So that is the purchase consideration. So you debit your investment, the investment in the subsidiary, which will be shown in the parent's statement of financial position as assets. Okay. Then what will happen is that you will now have a loan note. Your loan note will now what? Will now increase because you are issuing additional loan note to settle this. Okay. At the end of the year, the loan note is going to attract interest. The loan note is going to attract interest. Then you have to calculate the interest and send it to your profit or loss for the parents. Okay, what if there is an issuing cost? What if there is an issuing cost, transaction cost, professional cost, any other cost associated with the issuing of the loan note? It will be treated in line with what? IFRS 9. So if it has been issued at a discount, you know how to go about it. And the question will give you the effective interest rate. Okay, so if there's an issuing cost with the loan note, then you have to take the issuing cost from the amount in case you are giving effective interest rates. But if you're not giving effective interest rates, then the transaction cost will be capitalized as a separate item. Then a loan note will also be shown as a separate item. Then you calculate the interest because the question can just give you the nominal interest rate, which will be 8%. Okay, this is the interest on the what? On the nominal value. This is the interest that you are paying on the 80 million. So it means that if the transaction cost is 8 million and you are taking a transaction cost from this, the interest that you'll be calculating will be lower. That is not the actual interest. The actual interest should have been what? 8% on the 80 million. Okay, but you have incurred issuing cost of 8 million. If you are taking the issuing cost over here, from this one, you'll be having 72. If you are charging the interest using the nominal rate, it means that you are telling us that the amount issued is 72 million because the 8% will be charged on the what? On the nominal value. You can only subtract the 8 million from here when they have given you an effective interest of 10%. What does it mean having effective interest of 10%? It means that the effective interest rate has factored in the yearly amortization of the transaction cost and also the yearly interest on the nominal value. That is why we are having the 10% or whatever percent that will be given to you. But if you are giving only the nominal interest rate, which is 8%, then you have the loan note of 80 million. Then you also come and capitalize transaction costs, which will be shown as an asset of 8 million. So the loan note will last for 4 years, then you amortize this over 4 years. That is if you are not giving the effective interest rate. But if you are giving the effective interest rate, it means that the 2 million amortization of the transaction cost plus the yearly interest of 8% on the 80 million, which will be something like 0.08 times 80, 6.4. Okay, so it means that every year you'll be taking this one to profit or loss, 8.4. But if you are giving the effective interest rate, it means that the effective interest rate has taken into consideration the yearly interest rate, which is the nominal, plus what? The yearly amortization of what? The transaction cost. So you don't have to amortize the transaction cost as a separate item. You just subtract it from the 80 million. That is how we treat it if you are having effective interest rate. Okay, but the question might give you the effective interest rate or they might not give it to you. You just have to be very mindful when you are dealing with that. Although we are going to look at this under IFRS 9. Okay, if you are going to financial liability and financial assets, we'll talk about this one more. Okay, you can also issue preference shares, the same treatments. You debit investments, you credit the preference shares. Okay, you can also issue debentures, the same treatments, the same treatments. Okay, the transaction cost depends. The transaction cost will still be treated like how we treat transaction costs in line with IFRS 9 for all these ones. Okay, let's come to the other way of you settling this. Another way is you can also transfer your PPE to them. So transfer of PPE. So there can also be transfer of PPE. You can also transfer PPE to them. So transfer of PPE. Okay. So you are going to be transferring what asset to them. You say that, okay, we don't have money now, but we have land. We want to use the land to pay you. So you transfer PPE to them. What we have to know is that if the PPE has been transferred, the parent will not be the owner, or the parent will not be having ownership of the PPE again. So the PPE has to be disrecognized from their books. Okay. But what is going to happen is that you always have to ask yourself, was the PPE transferred at their carrying value or their fair value? So the question can give you the carrying value of the PPE and also the fair value of the PPE. Okay, so we have so they can give you the carrying value of the asset that has been transferred. Okay, the carrying value of the asset that has been transferred. So they can say the carrying value is 100 million, but this has been transferred at their fair value. The asset will be given to them at their fair value. Okay, because if in the market the value of the asset is 10 million, you are saying 100 million, I cannot get it as 100 million because if I also want to sell it, I cannot sell it for 100 million. So it will always be transferred at their fair value to them or their market value. Okay, so let's say the fair value is what? 120. That is the amount that the existing shareholders of the subsidiary can sell the land. Okay, what is going to happen? In our books, the value of the asset is what? 100 million. But we are now giving to them as what? At 120 million. What is happening there? So how much are we paying? How much are we paying for the shares? If the land will be given to them at 120, how much are we paying for the shares? Are we there? Okay. We are paying 120 million. Okay. But in the books, what is the value of the assets? We are giving them.
100.
Okay. So what is happening there? What will happen?
There's a gain of 20.
Okay. So there is a gain of what? 20. There is a gain of 20. Okay. Someone can look at this particular gain from so many perspectives. Okay. The first one is that you are going to what? Revalue the asset first before you transfer. Okay. So you now revalue the asset before you transfer. So that will be 100 against 120. So someone will say that there will be a revaluation surplus of what? 20. And so we credit the revaluation surplus, then we debit the PP by what? By 20. Okay. So it means that we have brought the value of the PP to 120. Then you will not transfer. If you transfer, are you going to have the PP on the premises of the company again for the parent? Will the parents have the kind of PP that they are transferring? Will it be part of their assets? Okay. It will not.
No.
Okay. So what you do is that whenever there is a transfer, whenever there is a transfer, you debit the investment with the fair value of the asset. That is what you are paying. That is what you are giving to them. That is the value that you are paying for. So you have transferred the asset already. So it means that you have sold the asset. So the revaluation surplus must be reclassified to profit or loss. Because the revaluation surplus, the question will always tell you that it will be realized after the asset has been sold. So since you have transferred the asset to them, it means that you have sold the asset. Okay, so just forget about the revaluation surplus side and come to this side. So we debit 120, then we remove the PP at their carrying value because that is what we have in our books, 100. So the difference will now go to profit or loss or group retained earnings of 20. So they can say a PP has been transferred. The PP will always be transferred at fair value because in your books, if you are saying that 100, but in the market, I can only sell this for 80. I won't accept it at what 100 because if I want to sell this thing immediately, I'm going to sell it for only 80. So I only accept the fair value of the building. So it can be a situation where the fair value will be lower than this one. That will be a loss. Okay. So as far as you are transferring the PP, you are not going to have the PP in your books again. So you have to now de-recognize the PP from your books. How do? You go and credit the asset account because PP is going to be having a debit balance. So you go to your PP. If the question says that this has not been recognized, okay, you pay attention to how they will be saying it. If they say this has not been recognized, it means that you are now coming to do it. But if they say this has been recognized already, it means that you don't have to subtract anything from the asset. So all of these ones, the treatment is the transaction has not been recognized. All the purchase consideration that we have looked at, the treatment that we are having over here is if the purchase consideration or that portion of the purchase consideration has not been recognized. But if it has already been recognized, then you only do the subsequent measurement, which may be interest cost or finance cost. So pay attention to whether it has been recognized or it has not been recognized. If it has been recognized, it means that the parent has done the right thing. So they have entered the things into their books already. So you'll be looking at the subsequent measurement of that particular item. But mostly not all of them will be recognized. Mostly it's only the cash consideration that they will be saying that it has been recognized. Because since you are paying cash, it means that you debit your investment and you credit your cash or bank account. Okay, so these are the ways that consideration can be settled. Okay, these are the ways that a consideration can be settled. All right, if you have paid for the shares, you ask yourself, what is the portion or what portion of the asset? What portion of the asset are you buying and you are paying this amount for? Okay, so if the purchase consideration was, okay, let me put purchase consideration. If the purchase consideration was 180 million and you are buying only 70%. Okay, so you just ask yourself. So the question will tell you so many ways that this thing. Okay, so you are buying 70%. Okay, what is the portion of the company that you are not buying?
30%.
30.
I'll give you 30%. Okay, so the 30% is what we call first. It was called minority interest. This is a majority interest, but now it is under the IFRS 10. It is now called non-controlling interest. It is that portion of the company that you are not controlling. You don't have control over it. So that's why they are saying non-controlling interest. The parents have no control over this 30%. They have control over only the 70%. So this 70% can we call the controlling interest or the parent holding. Okay. The question now is, you can see that you are not buying all the what? All the company. You are not buying all the company. So you are buying 70% of the company. Then you now ask yourself, okay, what is the value of the company? That would be net asset. We are buying the company. So the company, it is the what? The shareholders funds that we are going to be having, because the assumption is that the company will be financed through what? Equity and liability. But what will happen is that if we are able to give them all the value, they will use what? The portion to pay for what? The liabilities. So let's just settle the liability and give them the amount that they have to take. So we'll be having a net asset, which will be total assets minus total liabilities. Okay. So the question now is, if they are saying that the net asset is maybe 250 million. Okay. Okay. Assuming that there is no, the NCR are saying that they are not going to be having share of any invisible assets. So the question, the NCI, the valuation of the NCI can be two. We can use the fair value method, and we can also use the proportionate method for the NCI. So the NCI, the proportionate method, means that we don't have to, we just give us the share of the what? Of the physical or the tangible asset, the asset that we can see. So what will happen is that the total value of the company is 250, which is representing 100% what? Ownership. But this particular 250 now, it is being owned as the parent having 70% and the NCI having 30%. So if you want to share this based on their ownership, how much would the parent be having? The parent will be having 0.7 multiplied by 250. The NCI will be having 0.3 multiplied by 250. What are we going to be having?
175 for the parents.
Okay, 175 for the parent, and this will be 75. Is that correct?
Yes, please.
Okay. So the portion of the net asset that we are buying is what? Is 175, isn't it? Okay, but how much are we paying?
$180.
So what is happening there? You are paying
There is,
five. You are paying
there is
5.
a goodwill. I think there is a goodwill of 5.
There's a goodwill of 5.
Okay, so you are paying 5 in excess, isn't it?
Yeah.
Okay, so that 5 is technically called a goodwill. It might be for the employees, you are compensating them for the labor force that they have, or the customer base, or the allocation, and that is called the goodwill. Okay, so what do you have to do if you are giving?
Please, sir.
Yes, please.
In practical, can a struggling company be bought at a goodwill?
In practice, you can still be you can be struggling, but you can still want to compensate you for your location. Okay, the location will still be a strategic one. Okay, so they can still want to compensate you for the location. We have identified, oh, this particular location is this one. Maybe you are struggling because of your capital structure. Maybe you don't have enough resources to buy the goods to sell, because you don't have the capital there. Your capital is inadequate. So if you take over and we are going to pump in money, we'll be able to survive the company. Okay. So they can actually pay for that. But most cases, since we are all human beings, nobody will compensate you for that. Yes, we don't have bad will. We have what we call gain on bargain purchase. If the company is paying lower than what they are receiving, that is called a gain, but we call it gain on bargain purchase, not bad will. Are you okay? All right. So yes, I'm saying that this thing can be the goodwill. Okay, the goodwill calculation of the goodwill depends on the valuation of the NCI. So I'm saying that the NCI can be valued at the fair value or the proportionate method. The proportionate is that what is the existing net asset? Give us our portion. We are good to go. Okay, so we are going to be looking at whenever there is a purchase or whenever there is a business combination, ask yourself, is the amount that the parent is paying, is it up to, or is it the same as the portion of the net asset that they'll be receiving? So you first of all has to do that. So maybe the parent might be buying at a premium, and that premium is what we call the goodwill. So you first of all have to ask yourself, how much are we paying? What is the portion of the asset are we receiving? What is the portion of the net asset are we buying? So are we paying a premium? Are we going to be having a goodwill? You have to test for the goodwill. You have to calculate for the goodwill. You have to see whether the amount, you have to reconcile the amount that they are paying and the investment that they are making and what they are receiving. Are they the same? If they are the same, no problem. If they are not the same, what is happening? Are we paying more or we are paying less? That's what you have to do. Okay, so we are going to be looking at the first thing that you have to do is to look for the goodwill, whether there is a goodwill, whether there is a premium on the acquisition, whether there is a goodwill. Although you have to talk about a group structure, that is not a problem. Group structure is not a problem. Group structure is not a problem. If you are presenting your financial statement, the first thing that you have to think about is the group structure. And that one, you are not going to do any workings there. So that will give you some ticks. Okay. But the group structure is not a problem. So if we are solving a question, we put the group structure there. So the group structure is what is the parent holding in the subsidiary? What is the NCI holding? That is how you show. Then you show the acquisition date. When was the acquisition done? When is the reporting date? And when is the what? From the date of acquisition to the reporting date. How many years? How many months post-acquisition period? So that is what you are going to be doing. So I want to tell you that the first thing that you have to do is to see whether the acquisition is being done at a goodwill or there is a gain on bargain purchase. Okay, so gain on bargain purchase. Okay, so we have looked at how we should calculate the goodwill now. So you can see that we are comparing our net asset to the purchase consideration. So we can say that our goodwill is calculated as, okay, I will show this. It depends on how you want to calculate it. Are you okay? But mostly I use the simplest one. So we'll be using the one you know and the one I've been using. Okay. So we have the purchase consideration. So I will give you the two ways of doing that. And that will give you the purchase consideration of 180. That's what we have done. Then we look at the parent net assets. Okay, the parent net assets. And that is why we have the 175. Okay, then we have the 5. Okay, someone can also do this like this. We have the purchase consideration of 180. Then the person will say that the parents, let me talk about the parents net assets here and how it has been. So we have the total net assets minus 75. Is that correct?
Yeah.
Okay. So someone can say that, okay, you see that we are subtracting the 75 over here represent what?
Minority.
Okay. Represent the non-controlling interest. Okay. So you can see that the non-controlling interest, you are subtracting it from this one. Someone can say that, okay, instead of me subtracting the non-controlling interest from the net asset, let me just add it to this one. Okay, let me just add it and just take the total figure from it, because what are we doing? This will be subtracted. So if you're adding over here, it means that the 75 is included here. So you are now making it that so that the two sides will be 75, 75, then they can cancel. So someone will come here and say, I have a non-controlling interest of 75, because the non-controlling interest will be included in the 250. So I can go and subtract. I can go and make it over here. So that 75 over here against 75 in the 250 will just cancel themselves out. So the person will be having maybe 255, okay, as a total value of the entity. And the person will now bring the entire net asset as 250. Because why are we bringing the entire net asset? The non-controlling interest has been added to this. So this is this is supposed to be the total value. Then we now have our 5 million as the goodwill. So the goodwill, it depends on how you want to calculate it. But mostly what I do is that I always subtract the non-controlling interest from the total net asset and bring it towards to the calculation. So I will just find that particular value and move on. So you can also have purchase consideration. Instead of you subtracting the non-controlling interest from the net assets, you can add it and bring the total net asset. The 250 over here will cancel the 250 over here. So you'll be, at the end of the day, you are having 180 minus 175. Okay. What do you have to do? You can see that we are using certain components to calculate the goodwill or to estimate the goodwill. So you have to do the calculation for purchase consideration. So sometimes they can give you cash. Sometimes they can give you share exchange. You have to do the workings. Yes. It can be deferred consideration. You have to find today's value, the value that you are paying for the shares, less of the interest element. Contingent, you have to do the working. Transfer of PP, you have to do the working. Issuing of loan notes, you have to do the working and find your purchase consideration. Then the other thing that you have to do is that the question will not give you the net asset. They will not give you the net asset. And they also not give you the non-controlling interest. Or they can just make a statement on the non-controlling interest that the share price of the subsidiary is the fair representative of the non-controlling interest. So you have to go and look for the number of shares that the parent is not having control over and multiply by the current share price of the subsidiary. And that will give you the non-controlling interest. Or they can give it to you directly and they will tell you how the non-controlling interest is being valued. They can say it is the group policy to value non-controlling interest at fair value. If you are valuing the non-controlling interest at fair value, it means that non-controlling interest is having a share of the goodwill. So if there is an impairment of the goodwill, the impairment should be shared because I will show you if the non-controlling interest is at fair value. I will show you how that will be done. Let's come here. Okay, let's see the purchase consideration is. So this is proportionate. A situation where you just find a non-controlling interest with you multiplying or by you multiplying their percentage holding by the net asset is what we call proportionate method. That is what we call the proportionate method. Okay. But if the question has given you that, okay, the non-controlling, so they can say the purchase consideration is 180, but the net asset of the company, okay, is still the 250. But I will tell you that the non-controlling interest, the fair value of the non-controlling interest is 80. Okay, ask yourself, the percentage holding is still 70 and 30. The percentage holding is still 70 and 30. Okay, the actual non-controlling interest would have been what? 0.3 multiplied by 250, isn't it?
Yes.
And that will give us 75. Okay, but what are they having here as the fair value?
80.
Where is the 5 coming from?
Gain.
No, it's not gain. Okay, the 5.
The portion of
Yeah, the portion of what?
goodwill.
Okay, the 5 is their share of the goodwill. So it means that the goodwill is not only for the parents. NCI is also having the share of the goodwill. Okay, it means that NCI might be introducing additional capital for what? For the goodwill. They also pay, maybe they are introducing additional capital for the goodwill. So the actual value would have been 75, but they are giving you a fair value of what? of 80. It means that they are also having 5 million as a share of the goodwill. So the goodwill doesn't belong to only the parents. The situation where they are having only the 75, it means that they are having only the share of what? The physical asset, the tangible asset. So any impairment of goodwill will not affect them because they are not having a share of a goodwill. Okay, but since they are having a share of a goodwill, it means that whenever there is a goodwill or whenever there is an impairment of the goodwill, the 5 that they are having, it will also be impaired. That's why we share the impairment to the parent and then the subsidiary, because I say subsidiary and the parent and then the NCI, because NCI is also having a share of the goodwill. Okay, that is the idea about it. And the goodwill calculation over here, the goodwill calculation over here will be the goodwill calculation over here will be the purchase consideration, which is 180. Then you have the net asset of the parent. That will give you 250 minus what? 18 minus 80 rather. Okay, because the NCA is now having 80 of this. So that will give us 170. Okay, so this will now give us 10. So the goodwill, this 10, NCA is having what? 5,
Right.
and the parent is also having 5. But what you do is that it's an asset. They are all goodwill. So we just put the figures together as goodwill. So if there is an impairment of the goodwill, so someone can also calculate the goodwill. Some people, they might be getting confused because of what they know. Okay, so let me be using your own tool. I will not leave you like that. Okay, so we have the 180, then we have the NCI of the 80, then you have 260, then you now have the total net assets. Okay, we are adding the NCI because the NCI has not been subtracted. So the NCI is part of the 250. So 80 against 80, you'll be having 10. Okay, so since the NCI is having the share of the goodwill, any impairment on the goodwill will be shared in the proportion of their ownership. So that's why part of the goodwill will be shared to NCI, and part of it will be for the will be for the parents. The situation where NCI is having only the share of the physical asset, impairment of the goodwill will be for the parent because the goodwill belongs to only the parents. So that's why if you're using proportionate method, impairment charge will be for the parents alone. But if you're using fair value method for the NCI, it means that NCI is also having a share of what? Of the goodwill. So any impairment will go to NCI and then the parent in proportion or on the basis of their ownership. 70% of it will go for the parent, 30% will go for the NCI. What is the other thing that they have to ask you to find? Is the net asset. Okay, we are saying that the net asset over here is the total assets minus what? Total what? Liabilities. We are looking for only the portion, the shareholders fund, because the parent will assume the liabilities of the subsidiary. Okay, so what will happen is that we have the total asset minus total liabilities. That is the net asset. Okay, but what they will be giving to you, they will always give you what? The statement of financial position at the end of the year. You see, the asset of the subsidiary is the asset at the end of the year, not the asset at the date of acquisition. So we cannot use total asset minus what? Total liabilities, because the value of the assets in the statement of financial position of the subsidiary are always at the end, and which can happen that there can be acquisition of new asset during the year. There can be disposal of new asset during the year. There can be depreciation of asset during the year. So it means that the value of the asset over there is not the value at the date of acquisition, but we want to know the net asset at the date of acquisition. What is the value of the asset that we are buying? Okay, so what we do is that we don't use this total asset approach, but we calculate it from what? From the equity side. Okay, we calculate it from the equity side. So the question will always give you the share capital. They will give you the retained earnings at acquisition. They will give you maybe other components of equity and other issues. Okay, so let's come here. Let me use some illustrations. Let's say that we have property, plant, and equipment, PPE, at the date of acquisition to be what? To be 1,000. Okay. Let's say we have brand of the subsidiary to be maybe 500. Okay, let me make this one to be 10,000. Okay. Let me make this one to be 2,000. Okay. So I have the brand to be 2,000. Let me see what I have again. Maybe PPE. Maybe they also have investment property. Maybe they have investment property or maybe financial asset. Yeah, it depends. So investment property of 5,000. 5,000. Okay, then they will just give you the current asset. They have given you current asset of maybe 8,000. Okay. Then they'll give you, let's say they have given you current liabilities. Current liabilities of 2,500. And they have given you non-current liability. Non-current liabilities of 5,000. So maybe they are giving you the stated capital. They are giving you stated capital of 10,000. Retained earnings. Okay, let me calculate this before I will know how to share this. So 10 plus 2 plus 5 plus 8 minus 7.5. Okay, so they have given you retained earnings of 7,000, and they have given you revaluation surplus or other components of equity. So they are giving you revaluation surplus of 500. Okay, so let's assume that these are the balances for the subsidiary at the date of acquisition. How do we calculate the net assets? How do we calculate the net assets? What will be the total value of the assets? Let's put the total value of the asset together.
$25,000.
Okay, so we have 25,000 against what? Total liabilities is what?
7,500.
Okay, so the net asset will be 17,500, isn't it?
Yes.
Okay, so you can see that this value is the shareholders' fund, isn't it?
Yes.
Okay. Do you know that someone can also calculate the 17,500 using a different approach?
Yes.
Okay, the person know that whatever I'm going to be getting as a net asset will be the shareholders fund. So the person can have the stated capital. The person can have the stated capital at acquisition, which will be 10,000. And the person will be having retained earnings of,
and revaluation.
and the person will have the revaluation surplus of what? Of 500. Okay. So the person will now be having 17,500. So this is the net asset based on the book values. This is the net asset based on the book values. But what I'm saying is that the statement of financial position that will be given to you, you cannot be able to differentiate the asset at the date of acquisition and the asset at the end. They are just giving you the value of the asset at the end, which might not be the same as the value at acquisition. There can be disposal after the acquisition. There can be acquisition of new asset after the acquisition. Okay, so mostly we use the what? We use the equity side to calculate the net assets. Okay, these are the assets that we have in the books. Okay, these are the assets that we have in the books. By the time of acquisition, we want to acquire the business at its fair value. So at the date of acquisition, all assets and liabilities must be what? Must be fair valued. Okay, so the question can tell you that, okay, at the date of acquisition, a building has a fair value of 4,000 above its book value. So they can say at the date of acquisition, a building has a fair value of 4,000 above what? Its fair value. What does it mean? A building has a fair value of 4,000 above its fair value. It means that the value of the building should have been what?
It must
Should
be
that
the
be?
old.
It should have been the old plus the 4,000, isn't it?
Yes.
So that would have been the 14,000. Okay. Assuming we have factored in the increase, the net asset should have been what? 21,500. Is that correct?
Yes.
Okay. The net asset, the net asset at acquisition would have been what? 21,500. But what is the net asset that we have gotten?
7,500.
So it means that we haven't what? Factor in the what? The 4,000. So instead of us going back to do it, just come and add the increments, which will be 4,000 to this one. Then you now have the new value, because the net, if the asset is increasing and liability is constant, the net asset will increase, because net asset is calculated as total asset minus total liabilities. So if the asset is now increasing by 4,000 and we are still having the same value of the liability, then it will be what? The net asset will be increasing. So
Please,
yes, please.
so in effect, what will the new increment, the fair value increase, have on the shareholders' fund?
It will increase the shareholders' fund.
Through the revaluation or retained earnings?
No, you are not going to have anything with revaluation or retained earnings. At the date of acquisition, okay, you are going to be having the revaluation. That will be 4,000 at the date of acquisition. This is at the date of acquisition. So
okay,
it will be seen as a revaluation, but we don't show it as a revaluation. We just put it there, the value of the name of the asset, to show that it is the asset that is increasing.
all right.
All right. Okay. So I'm saying that at the date of acquisition, yeah, BC.
Yeah, so I think in effect, what our rather said, it will increase the net asset and then increase the equity, because like capital asset equal to capital plus liability. So if your net asset increase, automatically your capital also increase.
Okay. And the capital increase is what we are showing under the net assets. Okay. So the capital increase is what we are showing under the net assets, which would be now 17,500. Okay. What is the time? 5:56. Okay. So yes. If I take the net assets, I just want to show you something about the net assets and why you have been adding the 4,000 as a fair value increase and those ones to the net asset, and also the asset itself. The asset will increase by 4,000 and our equity side will also increase by 4,000. Okay. So it's 5:57. I want us to end it over here and continue tomorrow. Any question? Any question?
Please, no.
Okay. If there are no questions, please, I'll see you guys tomorrow at dawn, same time, same venue, same location. Thank you all for coming.
Thank you, sir.
All right.